Welcome everybody, it's the Crypto Sniper. Yes, let's check in on the mighty Bitcoin and what he is up to and doing. So, what's been going on? Well, you had a little bit of a pullback. Why did you have that pullback? Well, it's overall our assessment that in the macro, as we've said before, a quick recap for you, capping, descending grind line and a basing descending grind line that are the subatomic elements of a descending broadening pattern, which we put the splitter on, which tells you around which the general median of volatility expansion as you get further out that is occurring, around which you're pivoting. So it's quite typical on splitters for you to get rallies, part half rallies that then fail back, then broken with momentum, tested again, for example, broken with momentum, tested again, that usually means just run, tested again, just run, in between going to the other side, actually, a couple of times in between on that activity. So lots of interactions on the basing descending grind line, also the capping descending grind line, and a rest point. You're driving from Johannesburg to Cape Town, and you stop at the little concrete chairs in the Karoo to have your picnic and sandwiches, adjust the narrative wherever you live. There is a point at which you take a bit of a break. Continuation pattern to the downside, very flag-like, bit of a spill into it, the little attempt to rally away, a spill back down. All is part and parcel of interacting with the basing descending grind line after this double top that we called over here, that was Fox's ears, as you might remember, 2 touches on the capping descending grind line at the top side part of the overall descent that is alleviating, failing to make a new high, but just somewhat lower. That got the likes of Peter Brunn to say lower highs, lower lows is bearish. No, we said, because this is a bull pole. And in actual fact, it comes all the way from 25K, but this last bit is kind of strong. This overall is a continuation structure by our framing. In our opinion, could of course be wrong. And it's quite natural after you've broken with momentum, after that final huge volatility spiller, absolute thriller, when everybody suddenly learned about the USD JPY being such an important thing to watch that we spent all our time, many years talking about on the Market Sniper channel. If you follow us there, don't forget to subscribe on the Market Sniper channel as well. And we tell you the big things to watch. Debt markets, especially when you're in a yield curve inversion, debt markets, and then also the USD JPY itself, the dollar, all these things crypto guys should actually understand. And the king of anti-fiat's gold, which has also played a role in keeping a bid under Bitcoin as it now churns around the splitter that we are currently in. So you've got an impulsive move, you pull back to the splitter, you're a little bit of churning around, now looking strong away. Next stop is to the other side for our opinions, capping descending grind line, move over to the broadening on the other side. Eventually, as for gold before it, which is the lead steer and the god market of all anti-fiats, Bitcoin being the smaller but still god market of crypto, the subset that is crypto, is now going to get a little bit of continued support following the fact that gold has had the best 3-4 trading days since the yen carry trade collapse. And that has been very supportive for the anti-fiats category as well. Again, one of the reasons why. Get out of this Peter Schiff bad or gold bad thinking if you're in crypto. And same for, other parties the other way. We are seeing anti-fiats category, although I will differentiate between the digital and how it is far more potentially controlled and co-opted over that which is physically held. You will also get the greatest pumpermentals on the digital and less so on the physical. So this is what's been happening in this point, and we've pointed out that the pullbacks here probably going to turn out to be a good basis for accumulation. In our community, we had a live Q&A session that ended up going for about an hour and a half, where we discussed primarily this and more, and we were saying net accumulates on the lows, plus a great FX trade, by the way, involving no less than the yen. But you need to be in the community to find out about that. That first link below, book a call. No TMP, still not available. Sorry, but if you get a self-study, you can start learning the theory, getting up to speed on everything we do, getting the interaction of the weekend get-togethers, live seminars, and of course in attendance every month end as well on our live trading day, which won't be too far away. I think we're a couple of weeks away from that one again. Always a big moment. So that's Bitcoin. That's Bitcoin in its broadening. So I'm going to take that draw that I've just given you off and show you a number of things of how we annotated it. So the chart's going to get busy now. You have a look at it. I'm going to show you a couple of other things on lower time frames. Learning. So you're actually getting a bit of learning. Imagine how much learning you get in the full community. You're getting a little bit of learning here about what we're doing by following this channel. Help others learn by sharing the channel and remembering to hit the subscribe button and the like button to fool Google. You've got to fool the algo to make sure we do more content, and the content we do gets put in front of you. And the way you do that is you say, "Me likey long time, the market sniper." Okay, so let's leave our famous GI movies of the Vietnam War behind for a minute and just show you a couple of other things that were pointed out inside the community, which I can now tell you as they've played out. So a bit of an upward move. You can see again, bull arm. This says bull pole. That's the pole. We went up, climbed the pole. There it goes. And then the beginning of a series of marginally higher highs. Remember, we warn against that, especially if you're grinding marginally higher on the lows, which you just about were doing. A little bit of a fractal squeezy. Give me that flag, won't you, baby? I want to smash through the floor, and I want to go tumbling right down into the bottom of the basement there, because we're about to break the broadening ascending structure. In this instance, ascent, higher highs, and marginally higher lows, yet broadening, bigger volatility. So you have volatility expanding, you have wider swings, and only marginally higher highs. Fatal. You should expect a slam down. That's what tends to happen out of that. What did you get? You sure got it, baby. You sure got it. A little bit of a falling wedge, jacked you up to get you again to the splitter. Fast to the splitter. Grinding to the capping descending grind line. Where did you support test? There. You went again for the half move. Splitter, back up. Oh, gassed. I'm so gassed I can't get another millimeter from here, even though I started a bunch higher from there instead of from there. What ends up happening? Spill my guts, get a little bit of a bid back on the wick, can't hold, down. Bear flag, setting up, small time frame at the marginally increasing by gradient, basing descending grind line. That gives you a fractal setup for an eventual break. That was the spiller, the absolute thriller that you could have called. Down she broke. What did you get? Typical return move. Again, you flagged, but the volatility is increasing. A major candle here. The look one way, go the other way. Super volatile. It was all green right up to there. Looking so good. Where did it turn? Back at the basing descending grind line for the classic return move to the key levers and the key lines that we draw. So levels are price behavior. Lines are general gradients that are part of the pattern-based structures. The expectations is the basing descending grind line to break because of the ascending broadening structure on the bull pole, part of HVF method with the splitter theory that you can't get anywhere else. That's written up in our name, copyrighted, yours truly. That's right. That is right, and that's what you learn. That's when you get the spill, the return move, and then the utter capitulation after that rejection candle. Again, continuation patterns all the way. Little attempts to put hammers in. Not good enough, sir. Not good enough. Oh, dearie. Carry trade unwind. Puke. Puke. 48,000. You then go on this particular exchange, Bitstamp. Not the highest volume, but I like this particular chart. We've got the history. We love data. We want history, patterns, charts, real history. It all matters. Far more important than indicators, unless they involve other data such as volume, like volume by price, volume itself, and volatility measures. So here you go. You're basing out on the bottom of the larger descending this time. So on the lower time frame, this was an ascending warning that we're going to start our journey to the other side of the bigger structure on its basing descending grind line. Boom. Slow move. We could have had a real snapback rally. It never materialized. Then a bit of momentum came in and around. So what have I done? I've drawn a Fibonacci here from the high where you spilt. By the way, we predicted 70K rejection. Previous videos, we said you're going to go up to the 70K and the capping descending grind line, and you're going to go down. That's what we said. We said you could go down to the splitter, but if you're really unlucky, you could go all the way down to the bottom side. Boy, did we suddenly get that one right. At the same time, we were writing in, we just finished completing 26th, we released the Substack. Go see us, The Market Sniper, on Substack and subscribe. The 3 reasons why you are already deep in recession. That's right. One of them, the USD JPY, is showing carry trade unwind. At that point, we had been just beginning a sell-off that got a whole bunch worse. Long before everyone else was talking about the carry trade. That's now almost 3-4 weeks ago. We warned that the yield curve inversion was getting very close to reverting back positive, which is when the crisis come. Already happened for the 30-year and the 2-year yield curve reversion. Go and have a look at the Substack. And also we pointed to the collapsing copper market, which is actually an indicator of industrial activity, and highlighted that in actual fact, there's not much going on in business compared to normal. The copper is selling off, but that the monetary metal of gold is outperforming it. So we divided copper by gold and showed you a whole bunch. These are all big economic metrics that said it's about to get very unpleasant on the recession side. Subsequently, unemployment data came in after that Substack, a good few days after that Substack. What happened in that environment? The market got very, very afraid. Suddenly, bad news was no longer good news, bad news was bad news, and even good news became bad news, and the whole thing flipped, and we had a major unwind of risk on positions. This was deeply negative for the markets, risk off, and you got pullbacks. Gold within 3 days of the event, 3 trading days, Thursday, Friday, and Monday, and I haven't even included today, has done nothing but rally back, is in 0.3% from all-time highs. How's that for stability? To tell you that this is a macro bull market, and that its strength has allowed for this. So we were watching this on a lower time frame. So let's drop down to an even lower time frame. So I'm going to show you multiple time frames of analysis why we are long, and we chose Bitcoin at the splitter to break back up to the high side. So first of all, Sunday session, we were a bit long. I was lucky enough to sell that wick because I could see over the weekend, rather than getting a strong weekend, we are getting out. So I'd been beneficially long, not in the earliest parts of this, by the way. By the way, while we showing this, I'll tell you what I told the community members at the time. Lovely 5-legger trade. 1, 2, 3, 4. Not a 1.618 here, but a 5-leg trade. Then I got reasonably late. It's only after the momentum was starting to get somewhat big that I was getting in here, and I could see that the momentum was slightly turning a little bit more bullish. This had been rising wedge. We felt that there would be another sell-off. It could have done one of those. It didn't. It showed that it supported. We got a 5-leg up. You get in there. But then we saw this. Basing, descending grind line, very low vol, very flag-esque. Put a limit order across the top and totally reduced overall exposure. Caught a spill, but also showed the community that this could all turn into a macro flag by bias. What's happened? You made the last touches here on the base, legacy target at the 57,955. You've been squaring up. Gold continued to be strong. Our bias on gold being strong, and that it would put a floor on the Fiat alternatives. Remember something, guys. Remember something. Capping stone of this entire thing. This is that Illuminati thing that these guys do. The real bit of the top of the pyramid is this is a fiat and debt-based system that is in failure. Every time someone asks you for an economic comment, the first opening statement that will utterly ground you, slam those feet into the earth, release that negative charge, get yourself back in balance, grounded. The core central principle. This is a debt-based collapsing system. So on the seesaw, also with diagrams and beautiful images in our Substack. Don't forget to go and find the Substack and hit the subscribe. You're going to grow, you're going to learn, you're going to get smarter on these things, over here, the one just previous. Francis's Substack, it says, search the market sniper, view post, view new post. No, where's our post? Overview, oh my God, all these things. As usual, yours truly has no idea how to navigate his own site. The one before, the key indicators the recession is dipping. You can go have a look at that. The visual guides that highlight that we are in actual fact losing on debt. Down, and then we have a loss on fiat. You had the dollar strong phase. The long-term debt lost 45% from the July, August 2020 highs, or was it March 2020 highs? I can't quite remember. But we called short from August. I think it was March 2020 high. The debt lost 45%. Now they've got to talk interest rate cuts. That brings the debt up a bit, and now you're getting the dollar weak. You have an absolute puke on the USD JPY in terms of corrective aspects in there. That's the balance of the fiat and the treasuries. They are tied together. You borrow money into existence, and the borrowing asset is absolutely hyper over-proliferated, and nothing that is hyper over-proliferated. Think of my 10 mega oil tankers with pink crops. Hi, you want to buy pink crops? How many pairs do you want? Would you like 100,000 for your business? Sell them at any price you want. How does that make that a high value item? There is no scarcity. They're coming out of my ears. You can have as many as you want. Please take them away. Every cupboard I open, they're falling on top of my head. Scarcity is value. That's the whole notion of Bitcoin being 21 million and that there'll be no more and it's being slowly released. That is a concept that is understood in crypto as well. Scarcity, defined overall release. Gold can only pull out about 1.1%. In other words, it's just not easy to get. You have to break a whole bunch of rocks. That's open-ended, but you can compound at 1.1%. It doesn't get that big each year in terms of what's already been taken out the ground. So scarcity, unique properties. It's not only scarcity, unique properties. What can you do with it? What does it do that nothing else can do? Margarine is replaced by butter, is replaced by G. But scarcity and unique property. Anyway, so we go back to the chart on Bitcoin and we say, okay, flag-like structure. The bias of what we expect to break is the red line, and that has now just occurred. But we were prepared for that before. Entries matter. The difference between our community getting in here and you getting in there is a risk-reward based outcome, because stops can be tight under here. They could even be tight under there. But by the time you're chasing now, it's not yet a runaway market. It can pull back. This is low time frame analysis. By the time I get it out, it can already be invalidated. It doesn't make the larger time frame analysis incorrect. The flag could extend. It could turn into a broadening structure as well, and it could come all the way down to a lower low. It's not to show rightness or accuracy or have an ego element about any of this. You could do this. The point is, on the bigger time frame, you get greater reliability of compliance. But you could churn at the splitter quite a while. You could even dip potentially, it's not out of the question, right the way back down for a double dip to slightly lower, marginally low, before you return to the splitter and then go to the upside. That will run stops on the short time frame entries. So are you a short time frame entry guy trying to squeeze risk and then roll into the bigger time frames if you're right? Well, if we do the blue route, which means this is the break on the flag. Let's get the blue line, shall we? If that is it, and it goes for a nice flag up, and you get the benefit of that flag pole on the other. Let's remove the pink now. If you get that, and it turns out a good break, then you've actually had a good entry. There's the basing low. You should project from there, and up she goes. And then you could get the higher move all the way to the capping descending wide line. There could be some churn, a little bit of pullback there. It could be a little bit of choppery, a bit of this and a little bit of that. Or it could just keep on running, or it could need to wind up at that point. Don't forget, you have the 70K. It leans heavy on this market. We've not spent much time above the 70K. Let's go back up the time zones and just illustrate that point. You've not spent much time easily above the 70K. That is a blue line. You see it there. I can make him fat. He can pop for you a little more. There she goes. Let's go 3. So each time, there's the rejection we call on that. Boom, at the capping descending line line. Literally, they were coincidence together. That is incredible call, that actually. 2 key levels to be touched and rejected at. That is big level. Boy, that literally was the localized high before the yen carry trade unwind and all the bed shitting and headlines you've heard about since. That literally was it. 3 impulses, that's what we always say. On a broadening structure, also as for a tightening, each one getting bigger than the one before. That's a heck of a call that not many other people gave you for free here on YouTube. There's more of that when you click the link below and book a call. Grab your self-study, they are available. Start getting up to gear, and then later, you even have payment options, by the way, over 3x if it's a difficult time for you. Hey, I know the market's not that easy. I have empathy for that. I truly do. I want you to build your wealth in reset season. And you have to get skills as well. You can't follow. People want trade fee. It's kind of like, just write me a check. No. Grow with it. You will not manage your money well. You will not grow unless you're understanding what you're doing. The people that manage billions, if I gave you $1 billion to manage, most of you would lose it, I'm afraid to say. Yes, you might gamble it and actually make it go up to 10 first. 1 or 2 of you would get away with that. But in the long run, you'd lose it. You've got to grow. Your element of skill set has to grow with the responsibility of the greater sum of money and the use of leverage. And until you use it judiciously, that you are always practicing defense first before attack, you will be wiped out eventually, even if you get upside. So we need you to develop with that. You know, we can give you manna from heaven and you'll feast for a day, but you'll be hungry next year. Okay, so that little pitch aside. So what we think could happen is could be a move up, but it could also turn around and still chop about around the splitter. You can see the splitter just about in there. It's the dotted line. I can make him pop for you as well if you want. And there's the red capping descending grind line from the larger broadening structure that is descending of nature. Couple of other things just for you to consider, that like Fibonacci, for example. It's kind of always cute and interesting. So let's go back down to the 4 hour and explain that. So there was your megaphone that was ascending, that portrayed and gave you the top at the 3rd high, at the capping descending grind line and 70K meeting point. That was your top call. There was your spill. You go run a fib from that very significant top that has shown itself to be a real blocking point. You haven't spent much time at it, above it at all. In fact, you're not that much higher than the all-time high of 69, whatever's. You only, I think, traded 72 once or 73 maybe. So watch this. So that's 0 and that's 100 by definition, because I've dragged it from the 100 down to the 0. And isn't it interesting that you get a technical run of the 61.8? So more coincidences. Let's go back to transgender pink. Woohoo! Don't we just love that? You saw the Olympic closing ceremony and opening ceremony. We got to get with the flipping program, boy. Look at that support. Legacy targets 57,995 and 56,968, bottoming out very close to the 38.2. So you actually came up to the 61.8, had a pullback down to our key levels of significance, a great buying and accumulation point. You had support here at the 50 for when you grinded back up, and then you spilt with momentum, boom, 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 hammers back up, and then again, a little bit resisted. You can only technically trade through, pull back, and then broken the 50 with momentum, and here we are. So it's not a runaway trade. We spoke about gold. If gold's playing relevance in all of this, and you've got to get Bitcoin right, to get Solana right, to get all the other alts right, all the way through the macros. As I've said, we don't play crypto on the 396, although in the community, we will discuss smaller microcaps and really big opportunities. So there are those scopes for those degens. But we don't talk about them on YouTube. We're not interested in anyone making accusations of manipulation. We're not going to ever be close to anything that's pump and dump. We talk about the majors that have high liquidity that people can get in, and it should be 90% of what you do. If you are right, and you get to be damn right, the scale, don't chase the highest multiple. Chase the liquidity, chase the tradability, trade the structure, the ones with real value and money behind it, and you will be better served. You'll be better served than degens. Look at what a dull alt market it has been for the really micro caps and a lot of the alts. This has been Bitcoin dominance. We spoke about it last time, and it has been 1 or 2 alts like Solana and Tron that have done well. Okay, so what else were we going to tell you? Let's go and have a look at gold. We were telling you why this is significant, and you should watch also here. Gold is people betting on collapse. That big Illuminati guys that do that. Yes, that's right. every time you see that, debt and fiat collapse, it's a financial event. They're going to distract you like all goddamn hell with geopolitics, immigration, race wars, gender wars, cultural Marxism wars, Olympic ceremonies with people with testicolas out behind little girls. They're going to do every inversion, perversion they can to distract, a riot here, a riot there. But let me just say this to you, that it is a debt collapse. It is a financial event that has to happen. It is part of the Ponzi-nomics that they have perpetuated. They being those people. Since 1913, there's a great tweet you should see, since 1913, how it's actually gone once those special ones got hold of the market. You see, proliferation, inflation suddenly became a major thing. Just like the Weimar Republic after the First World War, the inversion, perversion in Berlin, the financial capitulation and destruction there. Great for people that steal the assets from everybody else, put their monkeys on greased poles, and then just keep adding muchos grease. Then you end up slipping no matter how hard you're climbing. You've got 3 inches of fat and lard and grease running down your pole. There's no way you climb up. There's no way in wealth terms you're going forward. The nominal number might go up. You are slipping into the shark pit there with all the fins and the salt water waiting to be consumed, while the other guy takes all your assets. Who is doing that, you might ask? Ask these questions. The quality of your life is determined by the quality of the questions you ask. Recognize who are your friends, who are your enemies. Take appropriate action to defend yourself in this reset times, because that's what you're facing. A financial collapse, an absolute debt as asset class collapse. You need to understand, massive social unrest goes with all of this. You need to build wealth. This is the time that traditional financial advice is utterly garbage and wrong. No 60-40 portfolio. It ain't going to do the job. We've shown it. We called it. The debt market, bull market, ended in 2020, never to come again, despite the fact that you will get rate cuts for a short period. Maybe now it's going to long run disappoint, and you could in fact be looking at a rate spike. You should be getting out of debt. You should be slowly accumulating gold, and you can accumulate some of the better quality, high cap, market cap cryptos for wealth building purposes. Don't trust them in long term. This is about wealth building. Sometimes you have to participate in the matrix to win. Don't forget, we've spoken about the hold your nose portfolios. That's the military industrial complex, the big pharma complex, and the Mag 7. We've spoken about it for the last 10 years. Sometimes you may as well make that money. That doesn't mean you approve of who they are. Someone else will get the upside on it. Anyway, so back to this. This is gold, and this is what gold has done. So that was the Wednesday of the 24th, the final low. So Thursday, Friday, and then into Monday. We're now going into Tuesday, and you have a collection of price behavior. Wait for it. That's your high, your all-time high for gold against the dollar. Currently stands 2,483. They really don't want that 2.5. That means you're as close to 3 grand than you are to 2 grand. That's right, 2,501, and you are closer to $3,000 than you are to the 2K mark, which was support not so long ago. After, listen to this, it's quite important. Watch the hands now, it's not going to the chart. After you had a big bull pole and a lengthy 3-year broadening structure, which is just a bigger version of what Bitcoin is in now, you got a beautiful upside HVF once you broke out the top of that descending capping ground line that sat on the 2K, think 70K for Bitcoin, 2K gold, and now you are actually in a situation where you're about to be closer to the 3,000 mark than the 2,000 mark, potentially in gold. As you are clumping up, the troops are clumping up along the border. How far away are you from the all-time high in dollar? This is the measuring stick, my good friends, only it's clicked in the wrong place. So let's try again. Put the magnet on and try one more time. There. This is how high right now at this very second. You are 0.65% away from your all-time high on gold. This move here has kept the anti-fiat war. Remember, people are still a bit nervous about the yen trade. They go gold, not Bitcoin. But the fact that the anti-monetarist is getting a bid, think of the debt collapse, the fiat collapse, the top of the triangle, the core principle, the cartel of criminals that use inflation to tax you from below and use tax bands to tax you from above, that are squeezing you into a nothingness. Go check the Bolshevik Revolution, what they did to the middle classes, both in violence, socially and financially. And you will know it's unpleasant. You should be getting out of the West. It's the West's turn to get Bolshevik. But anyway, back to this, 0.65% down. That is a significantly better performance. So Michael Saylor does. This is the inversion perversion, and I get called out for this, for criticizing Saylor. The volatility is a feature. No. The volatility is something that you need additional returns for. Additional returns for. This is an established principle. And Michael Saylor sometimes like to make retail garbage narratives like, how many chairs am I sitting on? Because why aren't you diversified? You should be all in Bitcoin. All in Bitcoin. Nothing else. Nothing else. You should say that nothing else. All in purely Bitcoin. In other words, follow me. I can't even, Richard Hart said that, all in hex and stake for whatever. Michael Saylor is just a bigger version with the more original gangster token. All in. You should be all in on nothing. So it's called portfolio theory. It's long established. If you're all in on that one basket of eggs and you're going for a bumpy ride like reset financial season, and that basket of eggs gets trashed in the bumpy thing, you eat nothing for the next 3 weeks. Having a bit of food somewhere else, stored somewhere else, that's not on the same bus ride, is a whole bunch smarter. Okay, a stable of horses over the fastest horse. Remember Raoul Powell, Bitcoin's the fastest horse, stable of horses. The fastest horse today is lame tomorrow, but the other one still gets you there. And the third one is the backup. And the powerful one pulls the shit up the hill. You see what I'm saying? Stable of horses. We have to deal with false narratives that keep getting pushed out. The fastest horse, stable of horses. Portfolio theory, long since established. Thank you, Michael. You shouldn't have all your eggs in your basket, even if it's your favorite and you love it and it's going to have the best things. The market will shock you. I've been in this market now. I first started activity in the market when I went to the army when I was 18 years old. Okay, and I've been engaged actively from when I was 25 all the way through. I'm a better part of 30 to 35-year veteran. The market shocks me regularly. The things I absolutely think would work that couldn't miss get absolutely trashed, and the ones I think have a decent chance often surprise to the upside, and the ones that I think kind of okay but may not work can win and can sometimes spill their gut. You have no idea about the future. You have possibilities and probabilities. The truth is, the fact that you think Bitcoin is the fastest horse is all the more reason that you brain drugged yourself into believing one thing, one winner, mono thought, only, this is the only guy, it's going to be the best that will serve all functions. Do we have one internet company? Do we have one internet browser? Do we have one of anything? Even where we have fake choice, whether it's Virgin Cola, Pepsi Cola, or Coca-Cola. You never have one of anything. Anyway, in terms of brand choices. But never mind. So Michael Saylor's latest thing is volatility is a feature. So we debunk his portfolio theory. You don't need to sit on more than one chair. As if physics and the stability of a chair in the present has got anything to do about possibilities and probabilities of asset valuations in the future. But let's also talk about this volatility as a feature. Volatility in financial markets is not new, and the more volatile the asset class, the much higher, because of risk aversion, and Blackman's skulls in pricing options have dealt with this. The higher the volatility, the higher, significantly higher, so it's a parabola, it's not linear, the potential return should be. And you'll say, yeah, that's Bitcoin. Okay, but then you add the aspect in, when they squeeze and crash the full markets, most people will be sellers at the lows. Most people will be sellers at the lows, and the higher volatility asset class will fall significantly more than the one that's 0.65% from its recent high after a major carry trend unwind and after the data finally revealed that there isn't a red hot labor market like these lying pigs have been telling you. when you first qualified for a recession, when it first was a recession, quite some time ago, that they denied on account of labor market. Because you get damn lies, outright deception, and then the Bureau of Labor Statistics stats. And that is the order in terms of the respect I give to each. And now you are finding out that you got a recession and you had a major risk unwind and you spill. This spill is done and reclaimed to within 0.65 of its high and has gone higher than what it was at its very highest point before that news broke. So it's already met, that was just before it broke. So if we take it from there, you're actually, since before the news met, 0.35. You're a third of a percent off that high. You have retraced everything. And at your very worst moments in it all, you were less than 5% down. Bitcoin has fallen from 70K to 48. Do the maths on that. You lost 22,000 down to 48. 22 over 48. 24 over 48 would almost require a 50% climb. So if you had lost 24K, you would have required a 50% climb to regain the highs. What climb did you need from your very worst low to get back to the high? Let's have a look on gold. To get back to your highest, your absolute highest wick. Get out of the way. There's a menu in the way. 4.79%. Do you want to have to do 50% even with your higher volatility asset, or do you want to have to do 4.79%? Okay, that's called stability. That's called stability. And when you have a portfolio, you think you're wild, you think you're tough, you think you can shoot for all the risk. I can take it, I can live with it. You go pale when you get a real crap the bed, spiller, thriller all the way from Manila. And let me tell you, this is actually a minor correction. They've made a lot about this. Everyone, yen trade, everybody's woken up to Japan suddenly as the cheap funding for the institutions. Do you get to borrow at 0.25% ever institutionally, hundreds of trillions? That's why we explain inflation works against the middle classes and the poor classes. There's a two-tier system. You've got institutions like JP Morgan that can get cheap dollars, that can borrow, convert Japanese yen at 0.25%, maybe a small margin on that. Don't forget it was 0.1% until recently. Convert it into dollars, watch the yen depreciate, what they owe depreciate, because the USD JPY has been going one way until this unwind, and go and stick it in treasuries. That's where your bid, and that's where your primary dealers have been making money and being allowed and okay with supporting the Ponzi-nomics of being the buyer of the ever-proliferated debt that Janet Yellen is creating at, you guessed it, every 100 days, 1 trillion. That is 3.65, by the way, in a year. And who's buying that stuff? The cabal of bankers that are co-opted. And how do they get to make money? It's a toxic asset because they get to borrow somewhere else at less than 1% and earn 5.5 here. Guess what? I'd take a couple of trillion of that as well and wait until events occur like you've just had now. And then you get all the new experts on the carry trade popping up in YouTube that had never discussed the USD JPY before, never watched it before, and now suddenly after the fact, super smart. News before the news, our Substack, go and find the Market Sniper. News before the news in our community before we come out with it on YouTube. You've got to respect the people that look after you and pay you first. And that is how it is. That is how it always will be. Click the first link below to find out more. Anyway, so gold is strong and gold is sitting close up here. Now it could have a little bit of a pullback. I'm not calling it straight to break. This isn't super bullish here a little bit. I think the possibilities you could have it's quite possible it has a pullback, a deeper pullback before and needs a bit more winding up. You're talking about a new high now against the dollar. Remember, the dollar is King Fiat. You've got the two kings. This is like a chess game. White king, black king, white king. The black king, the dark state king, is the dollar. The white king is the gold, and they are due to fight. And when the one is winning out over the other and is ready to make a new high, it's big news. They don't like that. So they don't want it to happen too fast. They don't want it to get too disorderly. They hate to have to write news headlines in the Wall Street Journal and all Bezos's rags that he owns from the Washington Post and all of them. Oh, gold's gone up and is actually killing the dollar. It's not good for the banking cabal. It's not good for the banking system. And as a result, they really don't like it until they're ready to let this controlled demolition of intent, not incompetence, of intent, to be pulled on their magical gematria day of choice when they will impoverish all of you and give you an interest rate spike. Until all of that, you aren't going to see anything material happen that they don't want to allow happen. But eventually, it's going to continue to leak out. Remember our call to the footsteps of the hills of 3,000 before further calls 6, 8, 7,000 plus for gold. You do not own enough gold. You should be saving in gold ounces before you are saving in Satoshis of Bitcoin. That is your stability. That is your friend. It will continue to hold value in the worst crash. That is why Michael Saylor, risk-adjusted return. How volatile are you? Ask the man who has a portfolio that does 20% and has a chart like this versus the guy who does 40% and has a chart like this. The super low vol 20% return per annum that looks like that is actually brilliant fund management. Very low in drawdowns, very low in that bad news. Doesn't matter when you sell, you're getting out pretty well, 20% versus the guy who starts at the same point and whose portfolio goes like that. You will know, even though this one did twice the return at the time, that the other portfolio is on a risk-adjusted basis due to beta pull-downs, drawbacks, the far better fund manager. This is a casino. This is a casino's return, and eventually you end up being a forced seller near one of the lows somewhere here, and the actual return attained minus fees could even be zero or below. Anyway, okay, so that is the debunk of the day. Volatility isn't a feature. It requires greater returns. You are not as big and as strong as you think you are. If you lost your job, your business got closed, your mate's business got closed, no one's buying any of your stuff no matter whatever you do, no one's buying any of your services no matter what you've done, all your clients have been killed, coordinated slapdown, the banks have been zeroed, the Russian hack has happened. What do you think's happening to Bitcoin? You think when you sell your Satoshis there, you're going to get top dollar or you're going to get bottom of the range? Do you think you're getting the 15,000 or the 150,000? The 15,000 was the low at the crash. If that event occurs, and it will be bigger than anything that's come before, you could see the lowest of low numbers. In gold, the fact that it only pulled down less than 5% is the feature. That's a feature. Low drawdowns. That's a benefit to you. Volatility comes with all the downsides that goes with volatility, as well as the assumed upsides. Most people do not get out at the highs when they're feeling rich. Why? Because it's awesome. You might get more rich tomorrow. Stay in. Greed keeps you in the trade. Retail is punished. Always. Greed keeps you in the trade. Pain gets you out. Pain gets you out. In the absence of method, pain gets you out. Forced meeting a rental check and feeding your children gets you out. And it gets you out at the goddamn bottom. Stop talking shit to retail crypto. Michael Saylor. Okay, there you go. You got it loud, hard, and strong from Market Sniper, the Crypto Sniper, and the Reset Sniper. You need a portfolio. You don't get all in. You need multiple horses in your stable. You don't chase the fastest horse. You need optionality. You need options in where you live, where you stay, who you pay tax to. You need options. It's called portfolio theory. It's called wisdom. It's called practicality. It's called Swiss Army knife over screwdriver. Okay, enough on that. This is the Crypto Sniper. It was meant to be a micro update. It turned into a rant. Wow, a rant. Okay, glad to have seen you all. Don't forget, hit the like and subscribe. Book a call on the link below so that you can start getting ahead of the game, making the right decisions from low time frames to medium time frames to big time frames. All the time frames of analysis. When is the right moment? Entries absolutely matter. Stop placement and a real chance of surviving in the early stage until the market moves away from you. Super key for big expansive rewards on tight risk. Multiple asset analysis, the 360-degree analysis, that is our key phrase that now other people are using as names on their Twitter handles to copy some of what we do. 360-degree analysis of the macroeconomic environment that also has bearing on crypto. By the way, you fell from 70K to 48. That is part and parcel entirely of macro. That is your yen unwind. That is everything else. You got the news on the Substack without even being in my community before any of that happened. On the 26th, over here, roundabout over there, while this was reflating, you could have sold up close to a localized high. Imagine what you get when you finally get into our community, which you can upgrade to potentially later when we make trading metamorphosis programs available. Once you've assumed and taken on some of the theory and attended our webinars in person or through the GoToMeeting function that we have with our Top Gun members and done the live trading days with us. Practical experience, theory backed with view-based and not 100% being right. It's not about right, it's not about wrong, it's how much you lose when the market moves against you and how much you make when the market moves for you. In other words, our long holding trades are usually deeply in profits and our losses are taken quickly. All the best traders have a very short duration of losing trades. People naturally hodl their losers and cull their good trades to cross-subsidize their weakest ones. This is some of the worst practices. You really need to understand this. There's all forms of matrices to recognize how you should be trading, and you can start with HVF method by clicking that link below and booking a call. Thank you, and I say goodbye until next time. Bye for now.